everyone, and welcome to a presentation from Prudential. When you saw the title to the presentation, you probably thought what I was all about today. But I thought it's a good idea to introduce the topic that is very close to my heart, and that is about human behavior and the impact that that has on one's own financial outcomes. You might ask why an asset manager is talking to you as about human behavior. But I think Carl Richards said it best in this simple picture of his when he said a client's lifetime return is effectively equal to his investment returns plus the impact of the investor's behavior. And while we as asset managers are mostly responsible for the investment return part of this equation, it is absolutely critical that we partner with guys like yourselves who holds the relationship with the client and can help the client manage their own investor behavior. Typically, you guys do that by creating a personalized financial plan for a client and help them stick to this plan throughout their lifetime. Generally, this goes very well until a year like 2020 comes along. In this famous quote from Mike Tyson, he said, "Everyone has got a plan till they get punched in the face." And I guess the financial equivalent of getting punched in the face was what we experienced last year with the all-share index dropping 34% odd in the space of a month. Now, if you take even a slightly wider view, over the last couple of years in South Africa, clients have been taking, or investors have been taking quite a bit of punches over the last couple of years. After some fantastic returns from mid-2000 to mid-2015, on this graph about 15% per annum, the last 5 years was effectively a flat JSE with no returns from the all-share index, and the cherry on top of the cake was obviously the dramatic fall middle of last year. Now, that puts a lot of pressure on a client's financial plan. And as you would all know from investor behavior, after a period of poor performance, the urge to do something about it is much more greater. So let's look at what investors did over the last couple of years with their investments. What I've used here is two categories of funds that investors typically use within their living annuities to draw on income: your multi-asset low equity category and your multi-asset income category. The red line on this graph depicts the difference of the average fund within those two categories. Where the line goes up, like in this picture, effectively the multi-asset low equity fund outperforms the multi-asset income funds over this couple of years to the tune of about 15%. We then analyzed what clients are doing in terms of investments into these categories of funds. And what I've put on the screen here is the quarterly net flows into each of those categories, with the pink part of that bar being the net flows into the multi-asset low equity category, your typical conservative balance funds, and the yellowish part, the flows into the multi-asset income part. Now, obviously, as the low equity funds, the conservative balance funds outperform the income funds, you'll see the majority of flows actually went into those funds that outperformed. And then at that point in time, mid-2015, when the picture changed around on the previous graph, you see when the JSE delivered flat returns, the income funds actually over the next couple of years outperformed to the tune of 15% over that period. And what we see if we looked at the flows completely changed around, with outflows out of the conservative balance funds and inflows into the income funds. The reason why I put a bit of a lag on that is typically it takes about 18 months for those flows to flip around, as clients are waiting to see on the fund fact sheets when the one-year fund performance number on the fund fact sheet of income funds is more than the multi-asset low equity, they start to move. And by the time the 3-year numbers are better in cash, clients are asking, why should I take the additional risk without getting rewarded? And they start flipping into cash. If I were to add all of those numbers together, in the 4 years up to 2016, you'll see in the red bar all the flows into the income categories, interest-bearing categories, multi-asset income, and the purple bar, the multi-asset, low, medium, and high equity categories. And you'll see over those 4 years, when the riskier assets outperformed, the flows went into those by quite a margin versus cash. Obviously, at that point in time, things started changing around, and over the next 3 years, you'll see a massive shift around with the 300-odd billion over those 3 years. That's nearly 100 billion a year going into those fixed income categories, with 16 billion in this picture, it looks like roughly zero, went into the riskier fund classes. Then when a year like 2020 comes around, with some stress in the financial system, you see that trend accelerate. And I've got 2020 on its own year, with more than 200 billion going into the fixed income categories for the year, and negative flows from the multi-asset higher risk categories, i.e. clients moved out of them. The question is, what is the impact of that on clients' returns? What I've got here is the 3 years leading up to March 2020, and the red line is effectively the average balance fund in South Africa compared to 2 of the average income funds, multi-asset income and interest-bearing short-term, your income and enhanced income funds. You'll see that even if you look at the 3-year numbers on the fund fact sheets, the balance funds completely underperformed. And at that point, clients are taking severe strain and coming to you as advisors to say, what should I do? I want to rather go to cash. There you get returns without risk. If you did it at that time, and from the previous graph, we can see over 200 billion moved from the riskier categories to cash, the impact is you switch from that bottom point in time. Now, if you went into one of the 2 income categories, that would have been your outcome. In this particular example, if you did nothing and stayed invested in the average balance fund, that would have been your outcome. And over that 1 year, the picture completely changes around. That's a 30-odd% difference in outcome for the client, i.e. the client capitulated at the worst point in time and switched to a comfort position. They're trying to buy comfort. Unfortunately, you can't buy past performance, and it's only future performance that matters. This is a 30-odd% difference. Now think about how often this happens in our lives. Every 10, 15 years, we see some of these events. If a client does that twice in his life, it's a severe impact on his retirement outcome one day. Another thing that clients often do is trying to chase yesterday's winner. What I've got on the picture here is effectively, we looked at the multi-asset low equity category, again, your conservative balance category. And what we particularly did is we looked at the 5 funds that took the most flows during 2020 and the 5 funds that took the least flows during 2020. On the right-hand side is the flow chart, and on the left hand is the performance. On the right hand, you can see the funds, those 5 funds took over each of the quarters in total 4.6 billion in net flows into those funds. And if I look at the performance of the back of which these switches came, you'll see for the 1 year ending March 2020, the column right on the left, there's 5 dots, and I've splitted the performance into the 4 quartiles of performance. All of those 5 funds happen to be in the top quartile of performing funds over that 1 year of an average 6.4% between them. Now, looking at the funds that had the worst outflows, you'll see those 5 funds had 16.7 billion rands worth of outflows during 2020. And surprise, surprise, if you look at the performance of those funds for their 1 year ending March 2020, they were all in the bottom quartile with the average between them of minus 10.5%. So effectively what happened here is clients looked at the funds which were the best funds over the 1 year ending March. These were the genius fund managers that all saw the coronavirus crisis coming and the market plunging, and clients subsequently switch into those funds. The interesting thing for me is clients, when they move into those funds, they don't get the past performance, they get the future performance of those funds. So the question is, how did the performance of these funds look over the next year, from March 2020 to March 2021? Interestingly, those 5 dots on the left-hand side in the top quartile, they deliver an average return of 11.5% over the year, 3 of them in the bottom quartile and 2 in the second and third quartile. And those supposed losers on the bottom quartile for the 1 year to March 2020, surprise, surprise, they all ended in the first quartile over the next year. So clients switch to comfort to the best performing fund. We obviously all do it because we want to be winners, but you can't buy that past performance and you actually hurt yourself even more. Now, I've been doing talks on investor behavior for about 13 years, and sometimes it feels to me like this. You probably have all seen the evergreen ship that got stuck in the Suez Canal, and this poor guy trying to free it bucket by bucket. But I guess maybe the silver lining, or me being the ever optimist, bucket by bucket, that guy, and with the help of some others, they got that ship freed. So maybe myself, together with all of you as financial advisors, we can help slowly change human behavior and allow clients to get a better outcome for themselves. I found an interesting study recently. It's a Canadian Value of Advice report that tried to look at the difference between clients' financial outcome, those that have got advisors and those that do not have advisors. And they split the study into how many years that the clients who had advisors had them for. And then they look at the impact on the assets. In this case, for clients who had advisors for a minimum of 4 years, had 1.58 times the money, the average assets under management, than the non-advised group. That's 58% more. For clients who had an advisor for at least 7 years, 7 to 14 years, they had 1.99% times the assets, i.e. nearly double the assets of the non-advised group. And for those who had an advisor for more than 15 years, they had 2.73 times more. That's a significant difference that advice can make. The reasons that they cited for this difference is a whole host of them, but the most important that they say is advised clients have a better allocation of assets into non-cash investments. And most importantly, the advisor introduces disciplined behavior, especially during periods of market volatility or crisis, which is exactly what we saw happening last year. Interestingly, they also looked at the non-financial benefits that this has on clients. And those clients that had advisors reported they had 3 times more peace of mind, they feel 3 times better prepared for retirement, and twice as better prepared for an emergency, which I'm sure came in very handy during 2020. I guess you might argue that many clients of your clients that you advise are already fully invested in various investment funds appropriate for their specific investment goals and categories, mostly probably in the PSG Wealth Solutions. And what I'm showing you on the graph here is 3 of our biggest funds that are included in the PSG Wealth Solutions, which I think is being run very, very well, and those funds are performing tremendously well. You'll see that from the 1st of January 2020 going into March, all 3 of these funds took quite a bit of pain, depending on, obviously, their level of risk assets. And I guess at that point in time, it's very difficult for clients to stay there. And with the help of you, you can help those clients and say, you are already fully invested. Stay, you've done your homework up front, you've created the plan, this is the right place for you to be. And I'm happy to say that these clients have been rewarded quite handsomely, and those funds had quite an enormous comeback, delivering very, very decent returns if you look at just more than 15 months period. Now, maybe you aren't excited about the 5% return or the 11% return, but if you look at where it was in March, it's a significant recovery of those numbers. You see 88% for the equity fund, down to 36% over that period for the inflation plus fund. And I guess the crux of my story today is in trying to help manage clients and their behavior during difficult times. I found this quote on the internet which actually says it best. We as asset managers and you as advisors, none of us know exactly what is going to come tomorrow. Tomorrow is uncertain, we don't know that. What we do know is most probably we will run into some stormy weather or some stormy seas. We know that. It does, and you can't change that. No matter how hard you try, it's impossible to change it. So it's best you learn how to sail in all those conditions, whether it's on the sea or in the financial markets. And that is our job and yourselves as financial advisors. Let's help our clients to sail better in all these conditions and reap the benefits of that. Thank you very much for your time, and I appreciate your ongoing support to our business.